This is nothing new in the story of leverage. And so in every cycle, what happens is various actors, companies, take on more and more aggressive positions using leverage to goose returns, which is age-old. It works. It definitely works. Now, what you're going to find in this situation is many crypto operators, particularly lending platforms, have never operated it with such volatility before. So they were in the slow growth from Bitcoin, almost a decade ago, from $800 all the way to $60,000. And all along the way, some of them became really aggressive in using leverage, which is the traditional hedge fund model. Now, what happens, and this happens in equities, it happens in bonds, it happens in real estate, it happens in crypto. Crypto's the Johnny-come-lately new asset class with a whole lot of newbies in it. You're going to see a whole series of these actors get crushed to zero over the next few months. In the contagion of leverage being caught offside with the lack of liquidity. Voyager is not that big a deal. It's kind of irrelevant in terms of, this is a diversified shareholder base. It's not FDIC insured in any way, so it's not putting any stress on the government systems in any way. All the shareholders should consider themselves educated, no different than when you go to Las Vegas, put it all on black, and it's red, you lose. That's exactly what's happened here. But the great news about this and why this is so good for the market and how this helps the crypto market is it educates the business models that aren't going to work. So it's like taking a big spatula from the sky and scraping all the crap out of the market. And it's going to happen very, very quickly. So anything that was built on a business model that is not going to work or can't sustain volatility is going to be gone. And it's a good thing. It's a wonderful thing. It's going to leave the industry much stronger. Yes, we must mourn the investors that got wiped out to zero, but even they are better off in the sense that they've been educated. Well, let's talk about that specifically, because I think it's a great topic, and for several reasons. Reason number one is people think that crypto, the entire sector, is going to get regulated all at once. That's not going to happen. The most likely scenario, and this is a personal opinion, but one I've been working on in Washington, along with others, is that we would like to get policy on just stablecoins first, because stablecoins represent a very powerful and efficient payment system. And we think we can get bipartisan support between both parties supporting the American dollar as a default currency for a global payment system. It's not going to be the Chinese yuan, it's not going to be the Swiss franc, it's not going to be the euro, it's not going to be the British pound. And the reason it would fall and default to the US dollar would be that that is the currency used to denominate most commodities. And so the challenge you have right now, and why there's so much pressure to solve this, is it's very inefficient to transfer US dollars over to Geneva, then put it into Swiss francs, and then buy Swiss Nestle stock or whatever it is you want to do over there. It's really slow, very inefficient, very costly, not transparent, and not easy to audit. And so all of that problem goes away with a stablecoin. Now, the proposed policy that you'll find in granular form in both the Hagerty and Toomey bills, and I've met with both of them, as many others have, this is very simple policy. What it looks as, it says, okay, for any stablecoin, an audit every 30 days. And any asset underlying, holding up the value of the coin or token, cannot have a duration of more than 12 months. Now, you've seen that policy before. It's called a money market fund, and you'll find it at Fidelity and Putnam and many other financial services entities that are FDIC insured. Circle, if it wished, that issues USDC, could become a bank. They could be FDIC insured if they wanted to, but they are sort of leading the pack with crypto in terms of payment systems under a stablecoin that has not broken a buck. So you've seen even Tether trades below $1. It's 0.999 right now. And so when you break a buck, you lose a lot of confidence. So what I'd like to see happen here is that so that's where you need management and compliance and total transparency. And so those who have opened accounts with Circle itself, managed it under corporate accounts, understand exactly what you just disclosed. But also the company is constantly monitoring its margin requirements and exactly what it's got and what it's holding. And if you have an account with Circle, you're getting a constant stream of information answering exactly those types of questions because they have their brand to protect. They also have that dollar strike value to protect, and they have their corporate accounts and account holders to protect. And they want to do that. They want to emerge from this successful, even though it's been tested with volatility. And I will remind you that recently it was disclosed that both Fidelity and BlackRock each invested $200 million in the Series F of Circle. That is a huge vote of confidence in the middle of all of this volatility. We're talking about the equity of the company. And so they're the most conservative money managers on earth, putting a bet forward on Circle becoming at least one of the regulated cryptocurrencies that are stable. And so at the end of the day, they have the risk too. We all have risk. But if I have to bet, I'll invest beside Fidelity and BlackRock, and that's exactly what I did. It's impossible to know, where the bottom is. But I would say this: I don't believe we've seen the bottom yet, and I have a different view of it. I go back again to other asset classes that I've invested in for decades. In every case, traditional bonds, traditional equities, real estate, alternative asset classes, bottoms are reached with an event, a panic event, as I call it. And you can find it in every asset class. Back in the hedge fund days when they started gating, these large multi-billion-dollar hedge funds that gated, shut down their liquidity, caused panic, and you saw bottoms in equities as they were being liquidated. There's long-term was one of the classics in the last couple of decades. And it was a fund that was over-levered and blew up. We haven't seen that yet in crypto land. There's no big guy has gone to zero yet, and I think that's still to come. Hard to say who it is because it's going to be because of leverage and some kind of relationship in a counterparty holding that they have not disclosed. And I'm just speculating right now, but that would be very healthy for the market to have that happen. Voyager's too small, it doesn't matter. The rest of these guys were kind of irrelevant in terms of total market cap. Bitcoin and the crypto market itself has almost been cut in half in total market cap. And so you would think we're on our way to the bottom, but I like a big panic event. That's always been a great way to bottom. It's towel throwing, it's capitulation, it's massive volume, it's total panic in the streets, and always a great buying opportunity. I have no idea who's next. Could be tomorrow morning, could be a month from now, but it's coming to a theater near you. And it will definitely be a very good thing for this industry. It'll be a great thing because it'll take out all of the bad, broken business models, the heavy leverage, the speculation that was too risky, and push everybody, and this kind of circles back to the conversation you were having with Ben at WonderFi. The reason I'm an investor in WonderFi is I need a place to store my crypto assets that fit into my compliance and accounting departments. And so, when WonderFi was able to offer me a centralized wallet at BitBuy, I was able to say to my auditors, look, you can audit this thing daily, weekly, quarterly, monthly, and I can mark to market each position for you at 4 o'clock, even though it's irrelevant in crypto land. It trades 24/7. But the old infrastructure of compliance that exists for all financial markets has not yet provided systems yet for anybody that wants to be compliant like I have to be. I don't have an option. I have to go through audit. I'm an investor in many other financial services companies that are issuers under regulations in many countries. We have to have our audit statements signed. Well, let's stay on crypto for a second. The point I was trying to make when I lost audio was that it's taken me a long time to convince my existing compliance and accounting infrastructure that supports my operating company's investments across a wide range of financial services to get on board with my positions in crypto. Because remember, I own WonderFi because I want to own infrastructure equity. Same for FTX, same for Circle. I'm a shareholder of those companies and Immutable Holdings in the NFT space. That's my basket of equities that are all compliant operations. They're all compliant. They all work under very strict compliance. That's the test that starts the equity investment. But the more interesting challenge that I solved recently with WonderFi again, with BitBuy, was to actually open an account, transfer all of my projects, whether it was a Polygon or Helium or whatever. I mean, all this stuff to me, these are not coins, it's just software. That's all it is. And moved it into, and slowly I'm doing this, I'm not finished yet, into BitBuy, where I can get a statement each month that my auditor gets before I do, and my compliance department marks to market every day at 4 o'clock. And I find it so humorous that the whole compliance world still marks to market crypto at 4:01 p.m. as if that means anything. Because it's trading 24/7. But they mark to market it because they have this giant infrastructure that reports back up, is there over leveraged positions, is the position more than 5%, depending on the mandate that it's held in. But this is what WonderFi is doing. It's working under the regulator, under an order, completely compliant, actually has a public auditor looking at it now, signing my statements. That's a big deal. That did not happen for years. And that's why I'd rather invest there, because that's going to become more and more and more important as regulation comes. The large institutions that don't own any crypto need the WonderFis of the world, totally compliant, whether it's decentralized or centralized, and auditors that can actually use the infrastructure they're building to make sure they can mark to market according to the traditional rules of compliance.
There's a commenter here asking if your stance on NFTs has changed at all from the utility of NFTs related to cars or watches.
I'm still a huge fan of NFTs for authentication, not for trading. I have never, ever traded one until the regulator tells me if it's a commodity or a security, because I don't want to get caught in that debate. But I have used them. Last week, there was an art exhibit in New York, and I bought a piece, and I asked the dealer and the artist, I will not take delivery without an authentication NFT. And they said, well, wait a second, we don't have one. I said, then you don't have a sale. I want that so I can send it to my insurance company. That's the way things are moving. I'm not trading that NFT. It's attached physically, if you want to think of it that way, to the piece of art I bought. It will trade when the physical art trades. But now I'm able to actually send the NFT to my insurance company and say, this is what I bought, this is when I bought it, here are the attributes of it, here's its physical location, it's on transportation now down to Florida to my home, and all of that is covered in this NFT. So that's the future of NFTs for me. I don't know about an ape or any of that stuff, because to me, where's the intrinsic value there? Somebody tried to sell me an ape for $362,000. It's now worth $60,000. That's not good.
All right, last question, and then I'll open it up to just final comments from both of you. So this question for both of you: what happens when people like Sam Bankman-Fried run out of money to keep bailing out companies in the industry, and maybe we do get that mass panic event? Are retail consumers going to want to be part of crypto when that event happens, or jump in, after that event happens? You first, Kevin O'Leary, then Ben.
Well, I have to disclose, I'm a shareholder. Ben, you should be aware, is a shareholder in WonderFi as well. He came in around the same time I did. I am a paid spokesperson for FTX, so I have a lot of respect for the management there. I did a lot of due diligence before I accepted that position because I wanted to have a compliant home. But Sam is one of the smarter guys in this space for this reason. Long before crypto, he was a trader. He understands the power of leverage, both to the dark side and the upside of performance. So I'm going to guess, and it's a personal opinion, the last guy to blow up is going to be Sam Bankman-Fried, because he doesn't get himself caught in over-leveraged positions. Now, they're very, very good in terms of managing their own business. He's got a huge team there. Ryan, the CEO. They also manage the Americas differently. They do the rest of the world. They're compliance. His parents are compliance lawyers at Stanford. I mean, he doesn't have a better heritage in terms of managing this process. So I think he's probably going to be one of the ones that picks up the pieces and has been doing that in recent purchases that are made public in various platforms that are just getting crushed. It's a long-term strategic move. I think it's smart.